Hello, we have done a report on the LendingTree. Our group members include Samantha Cantoni, Emma Huey, Josh Lamb, Anna Marundi, and Jasmine Silva. Doug Lebda is the founder and CEO of the LendingTree. Their headquarters are located in Charlotte, North Carolina. They were founded in 1996 as a way to better serve consumers. They were launched nationally in 1998, which provided consumers with a centralized location to receive multiple loan offers by filling out one simple form. Doug Lebda created the LendingTree for the purpose of giving choice back to the customer. Their mission and value statement is, Superior Lending Associates will provide outstanding mortgage brokerage services to our clients and loan officers by offering the best customer service. Their business level strategy is focused and differentiated. They differentiate themselves by offering a service that shops pricings for mortgages, cars, and personal loans to figure out who will be the best provider for the best price. The LendingTree has recently had major financial gains. Their key decisions and issues that they are currently facing include lack of customer service, untrustworthiness, hidden fees, and scams. When conducting an external analysis on the mortgage lending industry, we found that due to low rates, the industry is generally favorable. Average interest rates remain stable at 4.23%. Many are taking advantage of this and purchasing homes and also refinancing their current mortgages. One thing that has dramatically changed the industry is technology. They have switched over to online portals, which saves time, money, and resources. Home purchases are expected to rise to $1.24 trillion in 2019. Approximately 48% of Americans are currently looking or recently have invested in real estate. This graph gives you an idea of the ups and downs of the real estate market from 1991 to 2016. The mortgage lending industry depends on the real estate cycle. This has evolved since the 1900s. This is due to several laws and regulations that have been put into place. Some of these standards include requiring little or no income documentation, requiring little or no asset documentation, waiving the need for an appraisal to verify value of the property being financed, requiring minimum or no down payment, and allowing borrowers to avoid mortgage insurance if the first and the second mortgage combines for up to 100% of the value of the property. Fannie Mae has set these standards for the mortgage lending industry. Now we'll talk about the five forces model. The threat of new entrants is low, which is due to the high regulations in the industry. The bargaining power of suppliers is high, which is due to there being few firms in the industry and they are able to set the standard regarding prices. The bargaining power of buyers is low due to the rates being mandated, and the threat of substitute products is high due to many firms offering the exact same products. The rivalry among firms is also high because there are few firms offering the same product, so they kind of go neck and neck with each other. The industry is currently in the growth stage. This graph is the rates on a one-year adjustable mortgage in the U.S. from 2005 to 2016. So you can see where the rates spiked during the recession of 2008 and have been steadily declining until the 2016 presidential election, where you see a slight rise in interest rates. The structure of the industry is determined by government regulations. This includes a fixed rate mortgage, adjustable rate mortgage, balloon mortgage, and graduated payment mortgage. Standards are set in place to secure access to personal information due to past issues in the industry.
Next, examining the strategic group analysis of the mortgage lending industry, two aspects that appeal to all firms. These include services offered and easily accessible. Services and accessibility are important to firms and aid in the growth of a company. Some firms in the industry offer a variety of options when it comes to services, while some firms focus on other companies becoming more accessible to their customers. When examining Group 1, we can identify that this group offers a variety of services. This group includes companies like Wells Fargo and Citigroup. This group also has a long reputation and is well established to be able to offer services. However, this group has become slow when it comes to bringing their services to others easily. Group 2 includes firms that offer good services but does not have the advantage over Group 1, who offers a variety of good services that meet demand of customer needs. This group includes companies like Bank of America and JP Morgan Chase. Group 3 lacks a concern for offering a variety of services, but the focus for this group would be to reach their services to all customers easily with the use of technology. And this group includes companies like LendingTree and Quicken Loan. As a competitor environment, some of the main competitors for LendingTree are Bank of America and Citigroup, as well as Wells Fargo. In the mortgage loan industry, there is a low threat of entry to the industry due to well-established companies, changing laws and regulations, and economic changes. There is a high bargaining power of supply since there are few competitors in the industry. They can set standards regarding prices and deals within the industry. The bargaining power of buyers is low. This is due to mostly mandatory rates and the prices that the mortgage industry uses. We also see that the threat of substitute is high. There are few firms in the industry. However, quality and services that they provide are very similar to each other. That being said, the rivalry among firms in the mortgage lending industry is very high. Next, we take a look at the analysis for LendingTree. Revenue is important in all industries and must be explored to see how much companies are receiving. LendingTree has been above and beyond normal percentages in revenue changes. Wells Fargo had a 1.032% change in its span. Citigroup has changed in revenue with a negative 0.622% change. Put this into perspective, LendingTree has had an average change of 62.402% change in recent years. The reason LendingTree has been successful in recent years is based on more borrowers shopping online. Due to the advancements in technology for them to operate slowly online. Now we take a look at the net income. Net income is the amount of money left over after all expenses, taxes, and cost of goods sold. The average net profit margin for LendingTree in the past 5 years is 7.33%, compared to the average of competitors in the same time frame that is only 0.24% less. In the cash conversion cycle, shows the effectiveness of a company's management. This in turn shows how healthy a company is. LendingTree has an average 330.764 days to go through this cycle. It is a little difficult to compare this to its competitors, being that LendingTree is one of the only lenders who are not actually a bank. Leverage. Typically, banks have a lot of debt with loans. LendingTree changes that by not dealing specifically with having the money on hand, but instead being like a third party. LendingTree leverage did not fluctuate much in the last 5 years, but has doubled since 2006 to 2007. In 2006, LendingTree average was at 1.4, but at the end of 2007, it had reached 2.36. This means that LendingTree is starting to take bigger risks and is taking on more debt. Other than its recent spike, LendingTree has been relatively safe in keeping debt and equity ratios close. It seems that LendingTree has performed relatively poor to industry, but has caught fire in the last couple of years. They were great in certain areas, but it took years to catch up in others. The percent change in revenues was an anomaly to look at and seems great, but when compared to the fact that LendingTree is not turning money into income, should show signs of concern. This can mean a lot of things, but either way, they are not making it out with enough net income if their revenues were over 100% better than the previous years. Next, we'll look at value chain analysis. It is hard to create a value chain for a company that operates primarily online. LendingTree is more of a middleman, so this explains best how they create value. use of advertisement placed on Facebook or Google turns into click traffic that allows for LendingTree to see where most of their customers come from. They then contact those customers with multiple different lenders, banks, and credit partners. Excellent leaders with the founder Doug List, CEO, and President Neil Salvage have made a huge impact on the value of LendingTree. With them, they bring years of experience that are specific to their fields and intense schooling background. The CEO and president are new to their positions, with the CEO being there for 1 year and the president being in position for 2. They brought fresh eyes and rejuvenated the company. Since both have joined, revenues have skyrocketed and the net income has increased. It is important to take a look at the strengths, weaknesses, and opportunities and threats that LendingTree faces. Some of the strengths include convenient for customers for online access, efficient use of resources, offers both personal and commercial loans. Some of the weaknesses include lack of transparency and customer complaints. Some opportunities that are presented to LendingTree through the external environment include banks exiting the mortgage market, technological improvements, and some threat includes high threat of substitutes, aging population, political and government leaders, changing mortgage rate, increasing student debt, demand for office space, and demand for retail space. It is important that LendingTree be aware of some of the external threats that their company may face. Some of the biggest threats that LendingTree faces include aging population, as mentioned before, demand for retail space, and decreasing demand for office space. These threats may be exacerbated by some of LendingTree's weaknesses. One weakness that may exacerbate the threat of decreasing demand is LendingTree's customers' complaints. Decreasing demand can have a huge impact on a company's financials. Tying customer complaints in an industry with high substitutes, the effect of decreasing demand may be heightened drastically. One of the biggest opportunities in the mortgage industry is the increase in technological advances. More and more leaders are giving customers the opportunity to apply for loans online. Customers view online applications as an easier alternative to paper and in-person applications. Not only do customers like having the options of applying for loans online, it also allows companies to serve customers with fewer resources needed. LendingTree has already been utilizing new technology and is really making a push to head in the direction of a more online-based format. This has allowed LendingTree to have a competitive advantage over other competitors like JP Mortgage Chase, who offers online mortgages loan application, but is not the main focus of their business. Some of the key problems that would hurt the performance of LendingTree significantly in the near future will be its inability to satisfy customers. LendingTree's mission is to provide outstanding mortgage brokerage services to their clients and loan officers. Currently, LendingTree has maintained a competitive advantage by offering loan application online and a variety of other online services. LendingTree financial statement shows most of their customers are attached to the ease of the application process, as well as the promise of transparency and price comparison. The large difference in percent change of both companies can be linked to LendingTree's competitive advantage. JP Mortgage Chase saw a negative 6.22% change in revenues over the recent years, while LendingTree saw a 62.402% change in revenues. Any dissatisfied customer may simply choose to seek out another lending provider, one that may even potentially be offered better services. The critical issue that LendingTree needs to address is their reputation on customer. LendingTree is known to lack on their promises for lower interest and have no transparency in their extra fees and costs. Despite all of this, LendingTree has managed to perform well. Their current competitive advantage of offering services online has helped them stay ahead of competitors. However, there is no guarantee that this competitive advantage will last forever. LendingTree needs to address these key weaknesses in their company if they want to continue to be successful in the future. While decreasing demand in both the commercial and personal markets in the mortgage industry, it is vital for LendingTree to provide great services to maintain their market share. Our first recommendation for LendingTree would be to set up a customer feedback service. Setting up a customer feedback service will allow LendingTree to gain knowledge insight on what their customers are looking for in terms of services. This will allow LendingTree to distinguish between services that are working and which are not. Having a customer feedback service can help directly improve the quality of service offered and reduce the number of customers choosing other substitutes in the industry. According to an article written by FAST, 91% of unhappy customers who are not complainers simply leave. The second recommendation for LendingTree would be to implement a formal training program. This will help assist their employees in providing better customer service. Employee development and training programs are often overlooked, but studies show that investing in a training program is very important to keeping employees happy, satisfied, and engaged. Over $500 billion is lost every year due to employment disengagement. Although LendingTree is efficient in their operations, they still need to address issues of customer satisfaction. Implementing a more involved formal training program may address these issues and offer customers better experience with LendingTree. The third recommendation for LendingTree would be to have them make changes to the online application process. This is key in LendingTree's competitive advantage. To keep their competitive advantage, LendingTree needs to address and add value for the customers using online application process. The goal of updating the process should be to achieve the more transparent process for customers that offer a variety of options as well as price comparisons. Any of the recommendations, if implemented by LendingTree, would make a huge improvement and strengthen LendingTree's weaknesses. However, the recommendation that would result in the most impact would be updating the online application process for LendingTree. Making the online application process more transparent as well as better for price comparison will add the most value for current and future customers. There might be some resistance from management and executives in the implementation of this recommendation. Updating the online application process would entail a lot of coordination from multiple departments with LendingTree. Having to organize and decide the changes will be time-consuming and potentially costly for LendingTree. However, due to the added value for the products, as well as the potential increase in LendingTree's competitive advantage, in the end, this recommendation would provide the most benefit.